Hello and good morning everyone. This is Shaurya from Market Times TV, and now we will discuss what's going on in the global and Indian financial markets. Markets across the world are trading positive today after the signals from US White House advisor Larry Kudlow that the talks between US and China are going well. And after this, some positivity came in, and the fear that there might be delay or deal might be on impasse have been downplayed. So after that, Nikkei is up by 160 points, HSI is up by 85 points despite the protest. Shanghai is almost flat, while Indian markets are also positive as it gained more than 200 points. So first let's discuss what's the scenario of international markets and the factors behind the rally. Well, if we start with US and a trade war, then the things are not looking that great, but somewhat positive outcome has come. There was a time when no news was considered as a great news, but now no news means no news of the deal. So that's why when yesterday we got a news that things are going well, markets started acting in a positive way. But before that, even now, markets are not that positive that deal will completely get signed. As in a poll conducted by Reuters, economists have stated that they are not sure whether the deal between US and China will happen in a year, while they also added that the fear of recession in US is quite less. Now, it is being reported that there are some issues between both the countries, as Wall Street Journal reported that hesitation of China to buy a specific amount of agricultural products is creating an issue, while on the face, both sides are giving positive signals, as Chinese ministry spokesman Gao Feng stated that talks are going well, but seem to be sticking to the point that rolling back tariff would be the best way to go around after trade war and deal. Now, at the same time, Trump has clearly denied the last week that previously imposed tariff won't be rolled back, and this week he added that if China won't sign a deal, then there will be stricter action against the China. Both US and China wants a deal, as the economy is feeling the impact, and with Trump also having to face impeachment process, he is looking to win, and signing a deal with China will improve his approval rating, and once his approval rating will improve, it will put him in a better position to come out of impeachment without getting impeached, means he will stay in the power. China, on the other hand, has openly expected that the trade war is harming them, and they are also eager to sign the deal, but they are not the one in which it is mostly beneficial to the US. On economic front, things are not that great. GDP of Japan grew at mere 0.1% as compared to quarter-on-quarter 0.2% forecast, while last time it grew at 0.4%. Till now, Japan's exports were being impacted by the trade war, but its domestic demand was good, as it was supporting, and that was supporting the growth in the economy. But now, it seemed that even domestic consumption has started reducing, and now there is a fear that in next quarter, Japan might go into contraction, meaning its growth rate will be negative. Unemployment rate of Australia has increased from 5.2% to 5.3%. Industrial production of China rose below expectations at 4.7%, while last time it was 5.8%. Its retail sales fell from 7.8% to 7.2%, and this shows that there is slowdown in both consumption as well as production. Hence, various economists are predicting that growth rate of China can slip below 6%. Now, if we come to Europe, then Germany's GDP increased by mere 0.1%, and that has put in Germany in very tough situation. If on the one hand it would have fallen and came negative again, then Germany would have been technically in recession. Then government would have been more active to take up the measures to revive the economy. But right now, since they escaped the recession, this is not likely. And at the same time, 0.1 is very less, means the Germany's path ahead seems to be quite tricky and concerning. Germany is considered as the gauge to look at the European economy, and this escape has actually reduced the hope of stimulus, as said. Now, since Germany is export-oriented country, so international protectionism is impacting the exports, which in turn is harming the country. While consumer price inflation of France has remained constant after it fell last time, so it shows that conditions have improved. While condition of UK was just like that because its GDP may have come positive in the recent time, but its retail sales have fallen 0.1% month on month, indicating that Brexit and trade war is taking a toll on our country, which is right now buzzing with the election campaign where Boris Johnson seems to be in the lead. And GDP of Europe have increased at a constant pace of 0.2%, showing that monetary stimulus by ECB is preventing the economy from slowing at a faster pace. Means it is still not rising, but at least it is still rising. That's what we can say. From US, however, its PPI, producer price inflation for producers, have increased by 0.4%, indicating that the condition of US is quite good, because last time it fell by 0.3%, and this sustained the point that US economy is not close to recession. On fundamental level, if we talk about Indian markets today are following the global trend. They are positive, but a lot of volatility was observed yesterday, even in the rupee and in the Indian markets, and today they may be positive, but on fundamental level, the situation for Indian economy is not that great. As if we start with the GDP, GDP is low and its inflation is high. This is the definition of stagflation, and which is said to be the serious problem for the economy. At one point, India is expected to grow at even less than 5% this quarter due to fall in consumption, investment, and there is a liquidity crunch. Poor condition of NBFC sectors, which has led to triple balance sheet problem. It can be stated that there is enough liquidity with the banks, but that money is not reaching to all the channels and businesses, as banks are not willing to take higher amount of risk. So look, here's what's happening. Banks give loan to NBFCs, and NBFCs then further give loans to other businesses and corporate house and even to households. Now those corporates are unable to pay back the debt to NBFCs, maybe due to some reason, and sometimes they may not be getting payment from ahead. Whatever the reason is, since NBFC are not able to recover the dues, they are not able to pay back to the banks. So in this way, banks balance sheet is in problem, NBFC's balance sheet is in trouble from both the sides. They are not able to pay and they are not able to get the dues. So NBFC's balance sheet, banks balance sheet, and corporates which are unable to pay back the dues, their balance sheet is also in the problem. Hence there is triple balance sheet problem now from twin balance sheet problem, and this has created a serious issue with the GDP. That's why it is being said that the liquidity is there, enough liquidity is there in the system with the banks, but banks are not willing to give investments, and basically not to the risky investments, as the risk of giving payments to NBFCs or to other corporates which might not return is keeping the bank quite constrained, because at the one time their condition has not completely improved. Yes, it is improving, but still it's a long way to go. And beside this, there's a fear that any default may lead to a stricter action by the governments, so that is also preventing banks from giving very easily. Now they are also giving payment to good NBFCs, but not a whole complete sector, not even directly to the corporates. So that is creating the problem, because business model of bank means risk taking, and they are not taking the risks. So that's the reason why most of the financial institutions revise down GDP of India below 5%. And if you talk about inflation, that inflation has increased to 4.62%, mainly due to rise in vegetable prices, but WBI inflation has eased down to 0.16%. This is an interesting fact. Inflation for consumer has increased very fast, but that of wholesale has fallen. So the main reason for that is the weightage that is given to the different sectors. In consumer, since it is consumer price index focus on consumer, so higher weightage is given to the food basket. And since vegetable prices have increased by 26%, that's why there's a drag on CPI, because there's a higher weightage of CPI of vegetable prices. And vegetable prices have increased because of disruptive monsoon, which disrupted the supply. While WPI give higher weightage to manufacturing sector, and since there is a slump in this, WPI is lower. However, it is still expected that RBI will reduce the interest rate this time in the coming meeting, because at one point wholesale inflation is low. But on the other thing, even the core inflation of CPI, which exclude food and energy prices, is still below 4% at 3.47%. So this gives hope that RBI will again focus on growth and increasing the core inflation to around 4%. Beside this, government is also expected to come up with this sector specific reforms, and also the broader reforms are being urged in the form of labor markets and land reforms to improve the business environment of India. So if this happens, this all is being hope in the market, and that is also giving the rally which is being witnessing since quite few days, and today it's again high. Let's hope the things had improved, but if not, the path ahead looks volatile for sure for Indian markets as well as global markets ahead. If you like this video, then click on like button. Don't forget to subscribe the channels, and for more videos related to commodities and stock market, stay with Market Times TV.
आपको अगर हमारा वीडियो पसंद आया है तो इसे लाइक करें, साथ ही YouTube चैनल को सब्सक्राइब कीजिए और मोर अपडेट्स जानने के लिए बेल आइकन को दबाना न भूलें।